whether we're talking soybean oil, wheat, silver, or whatever, those big numbers are meaningful psychologically. Oh, we got $30 silver, now 40, and eventually 50, and maybe 60, 70, who knows? But it's a big deal. And all we need to see really is 3 or 4 closes on close of $40 or better in a row on this kind of volume. And we have a pretty good assurance that the trend is going to continue and that we're going higher. There's not much resistance. There's only, I think I read somebody yesterday, one of my colleagues in the precious metal space talked about, I think it was only about 2.5, 3 months where we've been above 40 on a consistent basis. So we don't have much resistance at all. Very few people that bought at that level are really holding now. I'm sure there's some out there, but from a technical perspective and a psychological perspective going hand in hand, you're seeing, I think, a jump probably to, I expect conservatively at least 10% more by the end of the year, which will put us at 44, and perhaps 20% more, which will put us at 48. Boils down to very simply, why are we moving? And it's, as I've said before, and it sounds trite, but it is true, and that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is, but we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum, and momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts.
Momentum in finance is much like physics. It represents speed and direction. In silver, momentum has turned upward. Algorithms programmed to follow trends are amplifying that move. Industrial buyers, especially in technology and energy, are accumulating silver at a steady pace. Nations like Russia are also diversifying reserves, while China has officially encouraged insurance firms to hold more gold. With silver being a smaller market, once momentum takes hold, price moves are sharper compared to gold. This explains why silver can leap by $1 in a single session, setting off psychological triggers for investors worldwide.
A lot of people think that the news, dictates markets. But if you look at Socioeconomics, a book that Robert Prechter wrote, who's an Elliott Wave guy, and some others, studies have been done independently, several. And really, people have the idea that news drives markets. At times it does, but it's really like 25% of the time. So if you look for a news item, like, a breakdown in negotiations or whatever, and that's what drove the market, again, it's buying pressure. Why? We really don't know. My guess would be the idea that the markets were closed in the United States, so that the aftermarket or the smaller markets in China, in Asia primarily, a little bit of buying pressure goes a long ways because there's no countervailing forces going on at the same time. Even though markets open in different time zones, the New Yorkers or people in Chicago or wherever can trade in the Globex, so they can be any market at any time if they choose to do so. So I think that really was probably part of it. That's how I would think about it, but am I right or wrong? I think really in the long term doesn't mean a lot. What it does mean is that it doesn't take much buying pressure to move this market. I think it was up over $1 yesterday on September 1st. And the last thing I have to say with tongue in cheek, but this adage goes on for miles, and I put it in almost every report in my April issue, that there's an adage that says sell in May and come back after Labor Day. And believe it or not, that adage holds true very often. And in the April edition of the Morgan Report, I said gold is topped at 3,500 and will remain so throughout the summer and maybe even longer. And so here we are, Labor Day, and it just shoots up. So I'm going to do an update for my premiums members today, later after we're done, talking about, here it is, we have proof. It's backing off in the U.S. markets right now somewhat, but it's holding a lot of the gains that it experienced yesterday.
Many assume breaking news dictates market direction. In reality, studies show headlines only influence markets about 20% of the time. What truly drives trends is underlying buying pressure. For instance, when U.S. markets close, small bursts of demand in Asia can spark outsized moves as fewer sellers push back. That's why silver sometimes rallies overnight before Western traders even react. Algorithms and institutional flows now outweigh traditional news-driven trading, making structural demand the main force behind sustained price increases, especially as global uncertainty pushes investors toward tangible assets like gold and silver.
Numbers in commodities in general are very important. There's a psychology that goes with it. And so whether we're talking soybean oil, wheat, silver, or whatever, those big numbers are meaningful psychologically. Oh, we got $30 silver, now 40, and eventually 50, and maybe 60, 70, who knows? But it's a big deal. And all we need to see really is 3 or 4 closes on close of $40 or better in a row on this kind of volume. And we have a pretty good assurance that the trend is going to continue and that we're going higher. There's not much resistance. There's only, I think I read somebody yesterday, one of my colleagues in the precious metal space talked about, I think it was only about 2.5, 3 months where we've been above 40 on a consistent basis. So we don't have much resistance at all. Very few people that bought at that level are really holding now. I'm sure there's some out there, but from a technical perspective and a psychological perspective going hand in hand, you're seeing, I think, a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell, maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing, it's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%, or if we, that type of thing. And we are starting to see a lot of strength in the miners, as you expressed.
Markets are influenced not only by fundamentals, but also by investor psychology. The old adage, sell in May and return after Labor Day, often proves true. This year, precious metals strengthened just as summer ended, reflecting seasonal buying patterns. Big round numbers like $30 or $40 silver carry huge psychological weight, attracting retail traders and institutional buyers alike. If silver holds above $40 for several sessions, history suggests the rally could continue toward $50 and beyond. These thresholds become self-reinforcing, encouraging further participation and pushing prices higher, especially as commodities broadly gain strength.
I've been in this market more than 40 years, and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip-off for somebody that's, studied these markets. These gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies because many of these companies are trading as if gold is at 2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And wherever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays, if any. There's really one silver stock I can think of that's more or less pure silver play. The rest are silver plays, but they have lead or zinc or copper or gold or something combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but it's equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
Mining stocks often act as a leading indicator for metals. Traditionally, when gold and silver rise, miners outperform by 2 or 3 times. Yet this cycle began differently. Metals surged before miners responded. Algorithms and institutional models still undervalue many producers, pricing them as if gold were at $2,000, not its recent higher range. As earnings catch up, mining stocks could rally sharply, offering leveraged exposure to the metals boom. Historically, during major bull markets, select miners have delivered 10-bagger returns. This delayed reaction in today's market suggests significant upside potential remains untapped.
Or below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier. You can do quite well and have a balanced risk to reward profile.
The silver market has repeatedly shown explosive potential. In 1979, Hecla Mining soared from $5 to $50 within a year, becoming the best performing stock on the NYSE. Similar patterns have reappeared during past bull runs, rewarding early investors. Today, most of the public remains unaware of silver's momentum, a classic sign of an undervalued sector. With industrial demand rising, global reserves diversifying, and miners still lagging, the long-term bull case remains strong. Whether silver ends the year near $44 or closer to $48, the underlying trend suggests we are only at the early stages of a broader move.
In 1979, Hecla Mining, which is right over there, I could drive to in an hour, their office, and the Lucky Friday Mine, was the best performing stock on the entire NYSE. It went from $5 to $50 in 1 year. And So I put Hecla Mining in the Morgan report in the early days, like year 2 or 3 of publication. And that stock was at about 50 cents, and it was in danger of being delisted because there's certain rules for a NYSE stock they have to abide by. That stock went from 50 cents to $5, a 10 bagger, the same exact metric it did in 1979 when it was published all over the financial press as being the best performing stock. I gave that lecture in Calgary at an oil meeting, oil and precious metals, and said, here we are, a 10 bagger. My readers know about it. I'm asking them to cash out at this level. And nobody even knew the word Hecla Mine. So it goes back to what you said. No one was paying attention. And that, I think, is a very good, clear, clean indicator for everybody listening to this that the bull market is far from over, in my opinion, because, again, who's paying attention? Not very many.